Currency, the lifeblood of empires. It is the very essence that fuels their growth and sustains their power. Throughout history, powerful empires have risen and fallen, their fates often intertwined with the strength of their currencies. One crucial factor in their destinies has been the stability of their currencies, which has determined their ability to trade and prosper. A strong and stable currency is the lifeblood of any empire, ensuring economic stability and growth. It facilitates trade, attracts investment, and projects an image of power and stability to both allies and adversaries. Conversely, a weak or volatile currency can cripple an empire's economy, undermine its political stability, and ultimately contribute to its downfall, leading to chaos and uncertainty. From the Roman Empire's denarius to the British Empire's pound sterling, currencies have played a pivotal role in shaping the course of history, influencing the rise and fall of great powers. The stability of a currency is often a reflection of the stability of the empire it represents, mirroring its economic health and governance. When an empire is strong and its economy is thriving, its currency tends to be strong as well, reinforcing its dominance and influence. However, when an empire faces challenges such as military defeats, economic crises, or political instability, its currency often reflects these troubles, signaling distress and vulnerability. The history of currency fluctuations is a fascinating lens through which to view the rise and fall of empires, offering insights into their economic strategies and resilience. By examining how different empires have managed their currencies, we can gain valuable insights into the factors that contribute to their success or failure, and the lessons they offer for modern economies. In this video, we will explore the impact of currency fluctuations on several historical empires, including the Russian, French, and German empires, as well as the empires that held the reserve currency status, the Dutch, British, and American. How the rise and fall of these economies shaped and changed their destinies. Through these historical examples, we will see how currency stability or instability has influenced the fortunes of empires, determining their ability to maintain power and influence. We will also examine the broader impact of currency fluctuations on society and governance, highlighting key events that have caused significant currency volatility and their repercussions. Finally, we will explore recent trends in the global currency landscape and discuss potential future scenarios, including the role of emerging economies, digital currencies, and the insights of renowned economists as we navigate the ever-evolving world of finance. For instance, the Roman Empire's denarius was a symbol of its economic might. A stable currency allowed Rome to expand its territories and maintain a vast network of trade routes. However, the debasement of the denarius, where silver content was reduced, led to inflation and economic instability, contributing to the empire's decline. Similarly, the British pound sterling was a cornerstone of the British Empire's global dominance, facilitating trade and investment across its colonies. Yet, economic mismanagement and the costs of two world wars strained the British economy, leading to the devaluation of the pound and the eventual decline of the empire. On the other hand, the Spanish doubloon was a strong currency during Spain's golden age, backed by vast amounts of gold and silver from the New World. But over-reliance on these precious metals led to inflation and economic stagnation, weakening Spain's economic foundation and contributing to its decline. The Dutch guilder was another example of a strong currency that supported the Dutch Golden Age, enabling the Netherlands to become a major trading power. However, military conflicts and economic competition from emerging powers like Britain eventually eroded the strength of the guilder, leading to the decline of Dutch influence. The American dollar has been a symbol of economic strength, supporting the United States' rise as a global superpower. Nonetheless, economic crises such as the Great Depression and the 2008 financial crisis have shown that even the strongest currencies can face significant challenges. These examples illustrate that while currency stability is crucial, it is not the sole determinant of an empire's fate. Other factors such as military strength, political stability, and economic policies also play vital roles. As we look to the future, understanding the complex interplay between currency stability and other factors will be essential for navigating the ever-changing global economic landscape. The Russian Empire, spanning centuries and vast territories, provides a compelling case study in the interplay of currency and empire. Under the reign of Tsar Nicholas I, Russia enjoyed a period of relative economic stability. The silver ruble, backed by the nation's substantial silver reserves, served as a reliable and widely accepted currency. This stability facilitated trade and bolstered the Tsar's regime. However, the Crimean War marked a turning point. The costly conflict drained Russia's treasury, forcing the government to print more rubles to finance the war effort. This increase in the money supply led to inflation, diminishing the ruble's purchasing power. While Tsar Alexander II implemented reforms to stabilize the currency, including the introduction of a gold standard, the ruble's value continued to fluctuate. The outbreak of World War I in 1914 proved catastrophic for the Russian ruble. The war effort placed immense strain on the Russian economy, leading to hyperinflation. The ruble's value plummeted, eroding public trust in the currency and exacerbating social unrest. The economic turmoil contributed to the February Revolution of 1917, which toppled the Tsarist regime. The Russian Empire's experience highlights the crucial link between currency stability, economic prosperity, and political legitimacy. While a sound currency alone cannot guarantee an empire's longevity, a weak or unstable currency can undermine its foundations and hasten its decline. The Tsarist ruble's fate serves as a stark reminder of the importance of sound monetary policy and the potential consequences of unchecked inflation. Another factor contributing to the ruble's decline was the slow pace of industrialization in Russia compared to Western Europe. While countries like Britain and Germany rapidly industrialized, Russia lagged behind, limiting its economic growth and resilience. Conversely, some argue that Russia's vast agricultural base provided a counterbalance, offering a steady source of income and trade. For instance, Russia was a major exporter of grain, which helped sustain its economy even during turbulent times. However, the reliance on agriculture also meant that the economy was vulnerable to poor harvests and global market fluctuations. The debate over the causes of the ruble's decline continues, with some historians emphasizing the role of military conflicts and others pointing to structural economic weaknesses. Ultimately, the fall of the Tsarist ruble illustrates the complex interplay of multiple factors, including monetary policy, industrialization, and external pressures. Understanding these dynamics provides valuable lessons for modern economies facing similar challenges. The story of the French franc offers another illuminating chapter in the annals of economic history. Unlike the Dutch guilder or the British pound, the French franc never attained the coveted status of a global reserve currency. This limitation hindered France's financial power and played a significant role in its economic struggles and eventual decline as a dominant global force. During the 18th and early 19th centuries, France was a formidable empire, both militarily and economically. However, the French Revolution and subsequent Napoleonic Wars drained the nation's resources. The franc, introduced after the Revolution, struggled to gain the same international trust and stability as the British pound. This lack of confidence restricted France's ability to borrow from international markets on favorable terms, unlike Britain, which could leverage its reserve currency status to fund its vast empire. The situation worsened during the Franco-Prussian War of 1870–71. France's defeat led to the imposition of a massive indemnity by Prussia, similar to the reparations faced by the Weimar Republic. To meet these obligations, the French government increased the money supply, leading to inflation and economic instability. Unlike the Dutch Republic, which had a strong trading economy to fall back on, France's economic base was severely weakened by continuous military conflicts and internal political turmoil. The inability to establish the franc as a reserve currency had long-term consequences. While the Dutch guilder's strength eventually became a liability, the franc never had the initial advantage of global trust and acceptance. This made it difficult for France to attract foreign investment and maintain economic stability, much like the challenges faced by the Weimar Republic. The French experience underscores the critical importance of having a stable and trusted currency in maintaining economic power. The lack of a reserve currency status meant that France had to rely more heavily on its internal resources and face higher borrowing costs. This hindered its ability to recover from economic setbacks and maintain its position as a leading global power. In contrast to the Dutch and British experiences, where initial economic strength provided a cushion against decline, France's economic vulnerabilities were exacerbated by its currency's lack of international acceptance. The story of the French franc serves as a cautionary tale about the importance of financial credibility and the far-reaching impact of currency stability on a nation's economic and political fortunes. In summary, the fall of the French franc illustrates how not having a reserve currency can significantly affect a nation's economic power and stability. When compared to the experiences of the Dutch Republic, the Weimar Republic, and the British Empire, it becomes clear that a trusted and stable currency is not just a financial instrument, but a cornerstone of national strength and resilience. The Weimar Republic, established in Germany after World War I, offers a stark contrast to the empires we've discussed so far. Unlike the English pound and the Dutch guilder, the Weimar Republic's currency, the Papiermark, never achieved the status of a reserve currency. This lack of financial clout significantly impacted Germany's economic stability and political legitimacy. The Treaty of Versailles, signed in 1919, imposed harsh reparations on Germany, demanding enormous sums of money that the fledgling Weimar government struggled to pay. To meet these obligations, the government resorted to printing more money, leading to one of the most infamous episodes of hyperinflation in history. Prices soared and the value of the paper mark plummeted. People needed wheelbarrows of money just to buy a loaf of bread. Unlike the Russian Empire, which had substantial silver and later gold reserves, or the Dutch Republic, which benefited from a booming trade economy, the Weimar Republic had neither. Its economy was devastated by war, and it faced enormous external debt. The lack of a stable reserve currency compounded these issues, making it nearly impossible to attract foreign investment or stabilize the economy. The hyperinflation crisis eroded public trust in the government and the currency, much like what happened with the Tsarist ruble during World War I. Social unrest grew and extremist political movements gained traction, eventually leading to the rise of the Nazi Party. The Weimar Republic's downfall serves as a grim reminder of the catastrophic consequences of unchecked inflation and the importance of a stable currency. In contrast to the Dutch Republic's experience, where a strong currency eventually became a liability due to over-reliance on a single industry, the Weimar Republic's weakness lay in its inability to stabilize its currency from the outset. While the Dutch faced external competition and internal political fragmentation, the Weimar Republic's challenges were exacerbated by external debt and reparations, coupled with a lack of industrial base to support rapid economic recovery. The Weimar Republic's fate underscores the importance of having a reserve currency and a diversified economy. It also highlights the devastating impact of external pressures such as war reparations on a nation's economic stability. Comparing the Weimar Republic to the Tsarist and Dutch experiences provides valuable lessons for modern economies. A strong, stable currency is crucial, but so is the ability to adapt and diversify in the face of changing global dynamics. In summary, the Weimar Republic's economic collapse was a complex interplay of internal weaknesses and external pressures, much like the Tsarist ruble and the Dutch guilder. However, its lack of a reserve currency and the burden of reparations set it apart, making its downfall a unique and cautionary tale in the annals of economic history. The Dutch Republic of the 17th century, often referred to as the Dutch Golden Age, offers another compelling example of currency's impact on empire. During this period, the Dutch guilder, a silver coin known for its consistent weight and purity, became the most trusted currency in Europe. This stability was largely due to the Dutch East India Company's successful trading ventures, which brought vast wealth into the Netherlands. The VOC's dominance in global trade, particularly in spices from Asia, fueled the Dutch economy and strengthened the guilder. The guilder's stability attracted foreign investment, further boosting the Dutch economy. Amsterdam became a global financial center, with the world's first official stock exchange established there in 1602. The Dutch Republic thrived, expanding its influence across the globe. However, the Dutch guilder's strength also contained the seeds of decline. The strong guilder made Dutch exports more expensive, eventually harming Dutch competitiveness in international markets. Moreover, the Dutch Republic's involvement in numerous wars, including conflicts with England and France, drained its treasury, and weakened its economy. By the 18th century, the Dutch Republic's economic and military power had waned. The guilder, while still a respected currency, no longer held the same dominance it once did. The Dutch Republic's experience demonstrates how a strong currency, while initially beneficial, can eventually become a liability if not managed carefully. It also highlights the importance of economic diversification and the dangers of over-reliance on a single industry or trading partner. Another factor contributing to the decline was the shifting trade routes and the rise of competing powers like England and France. These nations began to dominate trade routes that were once controlled by the Dutch, reducing the Netherlands' share in global commerce. On the other hand, some historians argue that internal factors, such as political fragmentation and social unrest, played a significant role in the decline. The decentralized political structure of the Dutch Republic often led to inefficiencies and conflicts among the provinces. Social unrest, including labor strikes and uprisings, further destabilized the economy and weakened the state's ability to respond to external threats. These internal challenges, combined with external pressures, created a complex web of factors that led to the eventual decline of the Dutch Golden Age. The story of the Dutch Republic serves as a reminder that the rise and fall of empires are often the result of multiple, interconnected factors. The British Pound, from global dominance to uncertain future. The British Empire, the largest empire in human history by landmass, spanned continents and influenced global affairs for centuries. It provides a particularly illuminating example of currency's role in both imperial rise and decline, showcasing the power dynamics of the era. For centuries, the British pound sterling, backed by gold and the strength of the British economy, was a symbol of financial stability and trust. It reigned supreme as the world's leading currency, facilitating international trade and economic growth. The pound's stability and global reach facilitated trade, financed the British Empire's expansion, and enabled the establishment of trade routes across the globe. This solidified London's position as a global financial hub, attracting merchants and investors from all corners of the world. The Industrial Revolution, which began in Britain in the late 18th century, marked a significant turning point. It further strengthened the pound's dominance as British innovations led to unprecedented economic growth. British manufacturing prowess and technological innovations fueled economic growth, making Britain a leader in global trade. This attracted investment from around the world, further cementing the pound's status as a reliable and stable currency. The pound became synonymous with stability and reliability, a cornerstone of the global financial system. It underpinned the British Empire's global economic and political power, facilitating its vast colonial network. However, the two world wars of the 20th century dealt a significant blow to the British pound, straining the economy and depleting resources. The wars also marked the beginning of the end for the empire it represented, leading to a period of decolonization. The wars depleted Britain's resources and weakened its economy, forcing significant changes in financial policies. This led the government to abandon the gold standard and devalue the pound in 1931, a move that had long-lasting effects on its global standing. While the pound remained an important currency after World War II, it gradually lost its preeminence to the US dollar. The rise of the US economy and the dollar's increasing influence overshadowed the pound's former glory. The decline of the British Empire and the pound's gradual loss of global reserve currency status highlight the dynamic nature of currency power, reflecting broader shifts in global economic dominance. Economic power often shifts over time, and currencies reflect these transitions, adapting to new realities. The story of the British pound is a testament to this ever-changing landscape. The British pound's journey from global dominance to its current status as a major but no longer preeminent currency underscores the importance of adaptability and the need for continuous economic innovation to maintain a leading position in the global financial system. The lessons learned from its history remain relevant today. The British pound's decline was significantly influenced by the economic strain of the world wars, which depleted resources and weakened the economy. However, some argue that the decline was also due to the rise of other economic powers, such as the United States, whose dollar became more attractive due to its growing economy and political stability. The Marshall Plan, which provided aid to Europe after World War II, significantly boosted the U.S. economy and solidified the dollar's dominance. Additionally, the shift from a gold-backed currency to fiat money changed the dynamics of global finance, making currencies more susceptible to market forces and political decisions. The 1971 decision by the U.S. to abandon the gold standard under President Nixon, known as the Nixon Shock, had profound effects on global currencies, including the British pound. These factors combined to create a complex web of influences that led to the pound's reduced status in the global financial system. The British pound's history is a rich tapestry of economic triumphs and challenges, reflecting the broader shifts in global power and finance. The American Century and the Reign of the Dollar. The rise of the United States as a global superpower in the 20th century coincided with the US dollar's ascent to become the world's dominant reserve currency, a status that has had profound implications for global economics and politics. Following World War II, the Bretton Woods Agreement of 1944 established a new global monetary order with the US dollar at its center, effectively making it the backbone of international finance. The dollar, pegged to gold, became the anchor for international trade and finance, providing a stable and reliable medium for global transactions. The U.S. economy's post-war boom, fueled by technological advancements, a growing middle class, and a stable political system, further solidified the dollar's dominance, making it indispensable in the global market. The dollar's stability and liquidity made it the currency of choice for international transactions, central bank reserves, and global commodity pricing, reinforcing its central role in the world economy. The phrase American Century reflected the country's economic, military, and cultural influence, with the US dollar serving as a symbol of this global reach and power. However, in recent decades, the US dollar's preeminence has faced challenges, including economic shifts and geopolitical changes. The US has experienced growing budget deficits, trade imbalances, and increasing national debt, which have raised concerns about the sustainability of its economic model. The decision to abandon the gold standard in 1971 raised questions about the dollar's long-term stability and its ability to maintain its dominant position. Moreover, the rise of emerging economies, particularly China, has created potential rivals to the dollar's global dominance, challenging its supremacy in international markets. While the US dollar remains the world's leading reserve currency, its future trajectory remains uncertain, influenced by various economic and political factors. Factors such as US economic policy, global geopolitical shifts, and the emergence of new technologies, including digital currencies, will likely shape the dollar's role in the international monetary system in the years to come, determining its future relevance and stability. During the 1980s, the US economy experienced significant growth under Reaganomics, which emphasized tax cuts, deregulation, and increased military spending. This period saw a resurgence in the dollar's strength and global influence. Conversely, the 1980s also witnessed the rise of Japan as an economic powerhouse, challenging the US in various sectors, including technology and automotive industries. This competition highlighted vulnerabilities in the US economic model. The 1990s tech boom, driven by innovations in Silicon Valley, further bolstered the US economy and the dollar's global standing. The rise of the internet and technology companies created new economic opportunities and reinforced the dollar's dominance. However, the late 1990s also saw the Asian financial crisis, which exposed the interconnectedness of global economies and the potential risks to the dollar's stability. The crisis required significant intervention from the International Monetary Fund and highlighted the need for robust economic policies. The 2008 financial crisis further tested the resilience of the US dollar. The collapse of major financial institutions and the ensuing global recession raised questions about the sustainability of the US financial system and the dollar's role as the world's reserve currency. The introduction of the euro in 1999 presented a significant challenge to the dollar's dominance. As the currency of the European Union, the euro quickly became a major player in international finance, offering an alternative to the dollar for global transactions and reserves. In recent years, the US-China trade war has further complicated the dollar's position. Tariffs and economic tensions between the two largest economies have created uncertainty in global markets, impacting the dollar's stability and influence. The rise of cryptocurrencies and blockchain technology represents another potential shift in the global financial landscape. Digital currencies like Bitcoin offer decentralized alternatives to traditional fiat currencies, challenging the dollar's hegemony in new and unprecedented ways. As we look to the future, the dollar's role in the international monetary system will be shaped by a complex interplay of economic policies, geopolitical dynamics, and technological advancements. The ongoing evolution of global finance will determine whether the dollar can maintain its preeminent position, or if new contenders will emerge to redefine the landscape. The future of global finance may mirror the past. Take these lessons from history. To understand the current financial system, it is essential to compare it with historical examples and draw lessons from past economic landscapes. The financial systems of previous empires, such as the British pound during the British Empire and the Dutch guilder in the Dutch Golden Age, offer valuable insights into the rise and fall of dominant currencies. The British pound, much like the US dollar, once held the position of the world's leading reserve currency. During the height of the British Empire, the pound sterling was synonymous with stability and global trade. Its decline, however, was precipitated by the economic strain of two world wars, the loss of colonies, and the rise of new economic powers. The pound's fall from grace underscores the impact of geopolitical shifts in economic policies on a currency's global standing. Similarly, the Dutch guilder was a prominent currency during the 17th century, supported by the strength of the Dutch Republic's trade networks and financial innovations. However, the decline of Dutch naval power and the emergence of competing nations led to the guilder's diminished role in global finance. These historical precedents highlight the vulnerability of even the most dominant currencies to changing global dynamics. Today, the US dollar faces its own set of challenges and uncertainties. The rise of digital currencies, such as Bitcoin, and the increasing influence of emerging economies like China, pose potential threats to the dollar's dominance. Cryptocurrencies offer decentralized and borderless financial transactions, challenging traditional fiat currencies and their centralized control. Economists and policymakers are closely monitoring these developments, considering the potential implications for the global financial system. While digital currencies present innovative opportunities, they also raise concerns about regulatory oversight, security, and stability. The future of global finance may see a hybrid system where traditional fiat currencies coexist with digital alternatives, reshaping the landscape of international trade and finance. Looking ahead, the economic outlook remains uncertain, influenced by various factors including technological advancements, geopolitical tensions, and environmental challenges. The ongoing evolution of global finance will require adaptability and resilience from nations and institutions alike. Just as history has shown, the dominant currency of today may not hold that position forever. As we navigate this complex and ever-changing financial landscape, the lessons from history remind us of the importance of sound economic policies, robust financial systems, and the need for continual innovation. The future of global finance will be shaped by the collective actions and decisions of governments, businesses, and individuals, determining the stability and prosperity of the world economy in the years to come.